Good morning, everybody. It is Friday, August 13th. About 6 weeks left in summer, and I think a lot of people are starting to realize that halfway through the summer already. I was out fishing yesterday, and I came off the boat, got everything filleted, and started to leave the marina, and it was packed on Milwaukee's lakefront. There were thousands of people outside. There were cars everywhere. Lakefront of Lake Michigan was just packed. I hadn't been down there in the summer on an evening for a couple of years, and I just more of this whole getting out and doing things approach. But I wake up this morning and I see that consumer sentiment has plunged to the lowest since 2011. And you have to think that maybe that's a bit of a contrary indicator longer term. Now, I don't know exactly what it means short term, because usually there's a bit of a malaise when sentiment gets this low. And that malaise back in 2011 actually took place in 2012 and 13. So I think we need to really consider where we are in the markets, and I'll have Shooter on at the end and we'll go through some charts. But I want you to really deeply think about where we really are in this cycle. And a while back, I said, I don't expect a recession until the middle of the decade or later. I really think that we're going to go several years without much in the way of any pullbacks, except if there's a pullback in China. If there's a pullback in China, which is very possible, then we could see a mini recession. But I don't see any collapses coming. I don't see any reasons why we can't solve any problems that come up. That said, don't ever forget the politicians don't want to miss any good opportunity to capitalize on a crisis, even a crisis that they may lead us into knowingly or unknowingly. So when I try to unravel all the things that go on in the economy, come back to that old phrase that Grandpa said to me and was reiterated a number of times by other people around me as I was growing up. If you want to know how things are really working, follow the money. So one of the reasons I went fishing last night was to take a couple guys out on the boat who I wanted to talk to about a project. And that project is a real estate development company that I'm launching, sustainable real estate development. And I'm going to fund it in 2 stages. I'm going to have the initial limited partnership with about a dozen investors between 100,000 and $1 million each. And that will set up all the legal entities and handle kind of the fail safes. But then I'm going to fund the larger entity, the one that will eventually become publicly listed, I think, through NFTs. And following the money, the reason I'm going to do this sustainable real estate development company is because there's $1 trillion roughly between the infrastructure package and the reconciliation bill that's coming. It's going to be pushed towards clean energy. At the same time, if you've been brushing up on your reading, you saw the climate change report that just came out, and you have already read the Pentagon's quadrennial report. And what you realize is that it's not just the energy administrations, it's not just the governments, it's not just the scientists, it's even the military who recognizes that climate change is the biggest threat to humanity, not only just burning us up, but changing weather patterns that affect migration. Wisconsin census came out yesterday, I believe it was, and I was taking a look at that. And Wisconsin's population increased about 3.5% over the last decade, which is essentially flat. It's lower than the increase across the country. But the migration of people from the Midwest and the Great Lakes region to other parts of the country has basically come to an end. That migration out of the Midwest and the Great Lakes region is going to reverse in the next decade. Why? Because climate change is that big of a deal. You're going to see massive, horrific problems with Florida's coastline. But I don't know that we're going to allocate trillions of dollars to save. Army Corps of Engineers already said, basically give up the shoreline. Build a wall, but build it pretty far inland. And from the wall to the ocean, expect it just to be sand someday, sand and water. As those things occur over the next 10, 20 years, us coming to the realization that we can't change what's already underway, whether we caused it or not, it's going to be a 50 or 100-year project to save the planet. In places They have some mild weather. They have fresh water. And I think that's the major thing there. They have fresh water. They're going to become very, very attractive places to live. I have two relatives and a friend who all sold their houses for way over asking. People from California who never came to look at the house. They looked at it online. They got an inspection. They bought it for $50,000 over asking, roughly in all three cases. Why? Arbitrage. Arbitrage is something that I do here. I live in Wisconsin. I make east-west coast income, but I live in Wisconsin. Seems like a lot of money here. I was living in New York or LA or San Francisco, I'd just be some guy. I could take that few $100,000 a year in Wisconsin, do really well. So it's a real estate development company that I'm starting, which we have some really interesting investors already. I think is going to allow a lot of people to make a lot of money. And I think we're going to raise an awful lot, given that we have the cryptocurrency angle. We'll see. So I wanted to give you that little update because I think it dovetails into a lot of things I've told you about in the investing recently. Last week, I talked about you need to be involved in the clean energy revolutions from every angle. And in particular, the places where there's recurring revenues without dramatically increasing expenses. Asset light. Because if you're not asset light, you're going to get eaten like this little fish here. I wanted to make a point that if you're not the predator, you're the prey. And in this market, there's a lot of predators. One might be this company. A little hedge fund. They actually have a stock that trades in the US. It's up 500%. They have a neat little trick. They found an American hedge fund to get their clients shares in hot US IPOs. Help bid those prices up. I haven't done all the reading and research, and a lot of this stuff is secret, but the regulators are looking at it. A lot of these stocks that have shot up, you wonder where the money is coming from sometimes. Where is the hot money coming from now? Back in 2007, 6, 5, 4, the hot money was coming from China, from Europe, from the Middle East, Asia. And that helped drive the housing boom because mortgages became super cheap and you had foreign investors actually buying properties too. So it wasn't just the Fed. They had a hand in it because they didn't regulate anything, kept rates low too long in 2003 and 4. All this hot money came in. So when you have hot money, people chasing in, and a lot of times they're herded in because somebody at the gate's like, well, if I buy all this stuff now, and then I let all this hot money in, it's going to make the stuff that I already bought much more expensive, and I can sell it to them at double, triple, 300, 400, 500% more in a short amount of time. When I saw this article this morning, I asked myself, I wonder if this is how the hot money's getting into the market right now. Maybe it's not just the Fed and the millennials and the Reddit army, or maybe they're just part of it. Maybe a lot of the hot money is sneaking in through some gateways that we weren't necessarily paying attention to. How else would the S&P 500 get to a price to earnings ratio of an all-time record over 40? The economy is basically in the same spot it was 2 years ago. Really no growth yet. You have the government pulling forward future bailouts from what I can tell. I just scratch my head. How long can it go on? Well, the stock market might be choppy for years from what I can tell from here. I tried to figure out, okay, how do I take my capital and still multiply it somehow? I think the easy answer is real estate, but also where do you think the hot money is going to stay? And where is the government largesse going to be positive? So in developing sustainable real estate, you're going to get all kinds of tax breaks on top of the tax breaks you already get from real estate. So I'll be looking for that in a couple of REITs. If I can find a couple of REITs out there that understand this, they'll probably be smaller in the hundreds of millions versus the billions, but they'll have growth and they'll have bigger margins, bigger rents, bigger tax breaks, and throw off bigger incomes. They got to be out there. That's the type of fund I'm going to start. Start with 4 or 5 buildings, 6 buildings maybe, and we'll go from there. Somebody else out there is probably already doing it. I haven't found it yet, but it's got to be out there. Can't be first. Across the board, while you look for opportunities, you need to keep an eye on where the risks are. And I don't know where this hot money is coming from, but this jumped out at me. How does this fund get IPOs siphoned off to their investors? Nobody else has pulled this off. This is a structure that has never existed before, and from all accounts, nobody else is doing it. Brokerage in Kazakhstan finds an American hedge fund, buy IPO shares for them, and then filter it to Kazakhstan and Eastern Europe. And it's nice that they have a gateway into America. But what if that hot money goes cold? What if a lot of these companies that are never going to make money get in trouble? I've been really interested in Airbnb. But the company that I'm developing is going to be a direct competitor to Airbnb and their big fees and what's becoming more restrictive policies. And I think there's a lot of guys out there like me who are going to say, screw Airbnb. I got a way around them. And I do. People with deeper pockets will too. So what happens when Airbnb doesn't become the juggernaut of profits that everybody is bidded up to be? Because you have a lot of guys like me who say, well, why don't I just build developments and run the rentals through the condo association or the building association? They do that down on Hollywood Beach. That's where I got the idea. So let's think about where all this hot money is, where it's going to, what's going to happen to it, and what's going to survive. And I think that what's going to probably survive the best has a lot of printed money thrown at it, tax breaks thrown at it. I think this probably telling us something. Talked about oil quite a bit lately. I've told you that oil demand is going to stop going up imminently. And 2, 3, 4 weeks after I said it last, we now have a report out that oil demand projections have all been cut by 1 million barrels a day. And that means that by 2023-ish, there will be no more oil demand increases. The growth in oil demand will become flat. We are, in fact, at the edge, maybe the last 1 or 2 steps up to that peak oil plateau that I kept talking about for years. That sometime in the 2020s, oil demand growth will disappear. And the run-on effect from that will be that the producers are going to get scared. Well, we better hurry up and sell this oil. It's not just going to be the frackers. It's going to be all these countries. And you've seen a big OPEC tiff recently, right? Saudi Arabia, UAE. Saudi Arabia didn't get exactly what they wanted. And there's going to be more of that. There's going to be more countries and more companies that start to pump a lot of oil again in the next year or two as they realize, wow, this window to sell oil is shrinking a lot faster than we thought. When you have Ford telling you that they can go all EV and hybrid in Europe by 2026, which is the year I've been telling you about for a year and a half. Well, the next thing you're going to hear is they're going to say, look, we're going to be all hybrid and EV in America ahead of schedule. Probably won't be 2030, which is what they're targeting. GM is targeting 2035. They're probably going to say, look, we're just going to do it across the board by 2027. Give us 1 extra year in America versus Europe. President Biden's told you that probably half of all the cars sold by 2030 will be non-internal combustion engine, basically EVs. I think he's way low. I think 80% of the cars sold by 2030 are going to be EV or at least a really good hybrid. I think that internal combustion engine cars are going to be for the rich on the new side and for the poor on the used side. You're going to see a glide path down on oil use starting by about 2030. It's going to plunge by late sometime in the 2030s, 2040 for sure. And that means the price of oil is going to go down because everybody's going to have to pump it to try to sell it. Otherwise, they're screwed. And at some point, the bondholders are going to realize, my God, we might not get paid. When that happens, it's going to be a storm of bankruptcies, forced bankruptcies, a lot of prepackaged stuff probably. Bondholders from all these companies are going to go to the boards and say, look, here's the deal. You can't extend this anymore. We're going to enforce the covenants. It's time to wipe out the shareholders so that you can pay us. And that's what's coming. Don't know how many years out, 3, 4, 5, 6, who knows. But I think the realization is already starting to be there. When you get headlines like this, that cheap oil is disappearing, it just means that more cheap oil is coming. These companies just can't support their debt loads, and the countries, they need the loot. Otherwise, they run up too big a debt. And the traders are already starting to bet on slow growth forever. Well, with all this hot money, how can it be slow growth forever? What does this headline mean to you? They're thinking that, hey, maybe the Fed doesn't raise rates at all. Why would they think that? Because they don't think it's going to grow as fast as everybody wants to make it out to be. The V-shaped recovery was just a rebound. There was no new growth. That's why we're pulling forward these bailouts. We had a crisis. Politicians were like, well, hey, let's not miss an opportunity to use a crisis the way we need to, the way we want to. So again, we're going to have to go where the money from the government goes. That's going to be clean energy and some infrastructure, technology. The space boom is part of that, right? What could spur the hot money to go cold quickly? Just headlines. If you piece together these headlines, you can figure it out. What happened last year when the Chinese ports shut down? We could see a huge whiff of stagflation here, which is something that I warned about in 2019, that we were setting up for it. I actually warned about it all during President Trump's presidency because I said these policies can lead to stagflation with any type of a shock. Well, we got a massive shock. Now we have supply chains goofed up, which I always thought would just be some sort of a fight, right? I didn't foresee a pandemic. I just thought the trade wars would ramp up, but we got that too. I don't foresee a gigantic crisis. However, I see the markets becoming more fragile and afraid of potential crisis. So when people get a whiff of, oh my God, this might be it, stocks are going to react very negatively. And those will be opportunities to buy the things that you want to buy. Recently, I've given you a whole bunch of stocks, smaller stocks, a lot of them around $10, $15, $20 a share. And I don't know if you're buying them. If you're not, these are already stocks that have been thrown out with the bathwater. Nobody wants those 4 satellite stocks that I've mentioned so far. The satellite is the service stocks. The ones that are going to help the cloud expand by hundreds of percent. Planet.com, Satellogic, Spire. EST Space Mobile has dropped again under $10 a share. You should be looking at selling puts on that right now. Any calls that you wrote should be expiring, just keeping that premium. OX, right? WeWork. These are companies that have already gotten the crap kicked out of them. Those are the places where you can get growth companies at value prices. And again, WeWork is the least favorite of the whole basket, and it's still pretty good. I've studied it enough to understand what the good parts are, and that management will head in that direction. Leave the bad parts behind. They've already gotten rid of a lot of the bad parts of WeWork and improved the balance sheet. You got a better valuation. So just like the gold miners shot up for a while because they had got rid of their bad parts, focused on their good parts, WeWork and some other companies are doing the same thing. I mentioned Pfizer a few months ago. Thing already ran that fast because that messenger RNA platform is a big deal. So if something like this gives us an opportunity to buy, or if the Fed actually tapering gives us an opportunity to buy, I really want to reiterate to you that you need to leave behind the bullshit of the way other people invest. 25 years ago, I started with zero. 20 years ago, I started with zero again because I got divorced. I really didn't start making serious investments, only $15,000 a year starting in 2001. And I ramped it up to more right around the financial crisis. I've invested under $300,000 in my life. Some of you saw the hint that I dropped in the chat room about what my IRA is worth now. So the ability to multiply money by investing the right way, which is to buy growth or assets or both when they're really cheap and then sit on them, is the way to make a ton of money. Charlie Munger told you, money is made by being patient, waiting for the cheap things that you bought that are worth a lot to be recognized by the market as being worth a lot. And there's a lot of companies out there with valuations of $1 billion, $2 billion, $3 billion that are all going to add zeros and be 10 baggers. And that's where I'm focusing. Now, would I buy Microsoft and Amazon and Google and Apple if the stock market dropped 30% and those all dropped 30, 40, 50%? Yeah, I'd buy them. I'd probably buy them through a fund just to have the basket, because the large caps are so correlated that trying to split hairs over a couple percent in either direction doesn't make a lot of sense. Why spend so much time on a few percent? And when I see an analyst say, oh, the Microsoft is undervalued by 17%, I laugh my ass off. Oh, Microsoft is undervalued by 17%. Okay, if you say so. Meanwhile, we have satellite stocks that are priced as if the cloud doesn't exist and that data is not a thing. And yet, we know the cloud is huge and growing, and that the data that's going to be provided through space is going to probably increase the size of the cloud 300, 400, 500% over the next decade or so, depending on whose study you read. You mean to tell me that none of these satellite companies are going to go up 300, 400, 500%? And that probably the leaders go up more? You got biotech company that because it's wrapped in a SPAC right now, nobody wants to buy. Kathy Wood just bought a whole bunch of it in a private transaction. That's why the price didn't move. So she soaked up a bunch of the float. What does that mean? It means there's less shares on the market to buy. So once people get interested, once some hot money finds its way to the table, share price are going to go up a lot. So I would strongly encourage you to go back to that plug and play stocks list, focus on the growth one, even if you're a retired investor, because most of those growth stocks you can sell puts on and get 3 times the premium than you would on a dividend from the dividend list. And I really want you to think that through too. If you're not selling cash secured puts yet, cancel your plans this weekend, or at least make time in the evening or something, or mornings, and learn how to sell puts. Go see some of the older videos. Because when you can sell a put with a 10% premium on a stock that you don't have to buy unless it drops 10%, you've got 10% income and a 10% margin of safety. day one. And you can probably do this transaction again in 3 months. You let it expire or be put to you. If it expires, you just wait for the price to dip again and you do it again. And if it gets put to you, you wait for it to go up a little bit, you sell a covered call and you sell another put when it drops. Rinse and repeat, the cycle is there. If you're telling me that you're an income investor for retirement and you're saying I'm going to get it through dividends, you're doing it wrong. You want some dividends, no doubt. There's dividend stocks out there, but not many of them are priced well anymore. So why would you take all that price risk to say, well, I'm going to collect a 4% dividend? When I'm telling you, you can buy a growth stock that doesn't carry any more risk than the overpriced dividend stock and create an income of 10% or greater just by selling these puts out of the money at prices that are lower than what they're trading today. Oh, we're going to take a look at some charts by Shooter. Get him hooked up here. Unmute him. Oh, I think he's already unmuted. There you are. How are you doing, Scott?
I'm doing great, man. How are you?
Pretty good. I'm going to try.
Decent catch yesterday.
Yeah, they were good fish. Big, good fish. Good, big fish. Good, big, good fish. All right, Scott, fire away. What are you telling us with this chart?
Well, I'm telling you, it looks to me like we're going to have some chop ahead of us.
Hey, did somebody else say that in the webinar today?
Yeah.
Okay.
Well, yeah, there's so much noise in this tape. It's not even funny. I mean, it's just, but Qs are, I mean, they're holding up well. However, they've sort of assumed the position of that the Dow was in 2 weeks ago. Right now we're looking for a range between that 363 and 369 until we put in that 5. Now, my standard retrace is the blue ABC. That's just the strategy that I use to trade. And basically, I just go off a fib retracement and then mark it on there. However, the auto scans are telling me it's going to be a little deeper. That's the 343. Now, that'll come in about August 25th. And, this is very much like what happened back in February and March of 2021. That's where it's almost assuming the exact same pattern back to the left of the chart there. So we're going to look at those type of rolls back at the left-hand side. And if you want to, you have any questions on that one, or you want to just flip to the SPY?
Well, so this is a shorter term chart. And
Correct.
I've got a couple of buddies, who do this sort of thing too. And they're telling me that this is like a best case scenario. They're seeing that volatility could really ramp up the next month or 2 or 3. They're really focusing on September.
Yeah. Well, that's what that 5 is there.
Yeah.
That 5 actually push out between September and October. So we're going to have, what I'm saying is we're going to put in a 5, have a drawdown. My work says, well, my strategy is it should be shallow based on the prior wave levels in fibs. However, Motive Wave is saying it should be deep, which it could be. All right. And then it's saying we're going to push back up and put it in all-time highs again. And then we're going to fail on the final 3 up there substantially. But that extends further out. If you go out, this is a broadening pattern that's happening here. This is only the first, where the blue ABC is. That's the first broadening. Then the second arrow is the second broadening. If we go out even further, there will probably be a third broadening that's deeper and broader. And that may continue. I mean, it's it's very hard to look with this much noise out any distance at all, because the counts are flipping back and forth. Even as far, even on the 4 hour, they're flipping back and forth.
Right. Back around the new year, I showed people a megaphone pattern that was out there, and the megaphone's a little bit broken right now because it just really has exceeded what anybody thought it could do that followed that pattern.
Mm-hmm.
What I believe is that we're going to have to navigate all the money that's out there, and I almost wonder if this is going to end up being like the waterfall patterns from 2008, where it fell off, it rebounded, it fell off, it rebounded, it fell off, it rebounded. The lows were all lower,
right?
And I wonder if we're going to get something like that, right? So you go boom, boom, boom. The other people I'm following are all saying right around 300 on QQQ is pretty likely, but they're saying we could
200 days very likely, actually, which is right around 326. We break below that 50-day. That really is going to be your tough. First, we have to break below the 8-day. But then from there, once we break below the 50-day, then we should be seeing a shot down at the 200-day. But I don't think that'll come till mid-September, early October. Okay. But I think we have enough. One reason I'm in that HYG in October, is September 15th really is sort of the drop dead date. Either we come off by that timeline, and we start seeing some risk hit the tape, which obviously would push the VIX and the VIX up and HYG down. Or then this thing, they're capable of holding this thing up and it's going to continue to grind higher. That's sort of my thesis that I have in my head, because I've been shocked that they've held it up with certain things that have occurred already. And you can see the buys come in. A good example was even Sunday when we had those $20,000 future contracts put on the market. That's one reason gold had that significant drop. Right. That was a form of manipulation, and you can see the buyers come in the tape. I mean, nobody comes in and buys 25,000 contracts in the SPY. Nobody does.
What word did you just use?
Say that again.
Manipulation.
Yes.
So you think the markets might be a little manipulated?
Of course.
Huh. Like certain entities herd hot money into certain places.
Well, it's just like the crypto market. I mean, come on, let's be real. It's unregulated.
Wait. Crypto might be a little bit manipulated?
No, of course, it's completely manipulated. But that's hey, as long as they make it legal and they're not going to penalize me for playing the game, I'm okay with that. If you bring the regulation in, then we follow the rules. We're a country of laws. If there's no rules, hey, but I tend to disagree with the fact that the Fed, in some way, I think they manipulate it by where they shovel money. Like, for example, you were talking about that RIT coming in and being able to control a piece of the market in a fashion that nobody else is capable of doing that. And that's just
hedge funds,
yeah, that's just like the dark pools. I mean, the reason the dark pools are there, they're trying to hide something from us, but they're ultimately manipulating our dollars if we're playing the game. So, if I can see it, that's a good thing. What I don't like is when I can't see it, and that's a whole different ballgame.
All right. SPY, basically the same as QQQ, probably going to get choppy.
No, actually, it's holding up much better. I think we just continue to grind higher on the SPY. It looks completely different than the Qs.
Okay.
We're going to be in that range between 446 and 429, I think. Right. So I do think there's a little drawdown possible, back to about the 382 fib. And then we'll push for that 3, and then we'll be looking for a similar drawdown, between September and October as well. So they're aligning there.
Right. But then ultimately, at some point, we'll have a SPY of around 350, which I got mocked in that article that I put out there when I said 350. Some kid said, "Oh, you mean 410 to 450?" I'm like, "No, 310 to 350. Look at the chart." Yeah. And he's like, "Oh, that can't happen." Like, okay.
They always revert. I mean, there's millions of non-believers out there in the mean, but if they're going to get extreme, they're going to revert.
Well, and I think that there's enough of them now that know how to go short the market, right? They've had some practice now. I think that there is a good possibility that the government's going to be behind, right? I mean, the Fed's going to be like, what the hell is going on, when enough of the millennials start saying, well, it's going down, so let's make money on it going down.
Yeah.
Right? And they don't have any remorse about taking baby boomer and older people's money in the market.
Yeah. Those circuit breakers can be expanded quickly, though. Let me tell you what. One thing I've seen is that the brokers now are manipulating the margins across the board, depending on what tickers you're in. When they start seeing too much volatility, right, they just squeeze the margins to pull you out of the trades or basically block people from going into the trades.
Right.
And I think that's sort of how Congress, in some backdoor way, responded to what was going on with the meme stocks, because it started like 2 weeks after that.
Right. And I will say there was a headline in Bloomberg, I think in the last week. I think it was over the weekend. I think I read it on Sunday, that talked about how liquidity was, they said leaving the market, but I think it was the better way of saying it would have been the way you said it, is just the liquidity was being controlled.
Yeah, there's a hole in the pool. I mean, the credit default swaps had a 25% pop the end of last week.
Yeah.
I mean, which is a huge, that just indicates that we have a huge US dollar shortage somewhere.
When these corrections occur, they're going to happen fast. Is kind of
I think we're going to be blindsided, and you're not going to have time to respond. That's my impression.
So, folks, you sell into this strength, get down to whatever your most conservative asset allocation is, which should not be 100% cash. Right? Don't ever go 100% cash, because we can be wrong and the market can be more irrational than we consider. But if you're a conservative, I can't take a 30% drawdown type of person, around half in cash makes a lot of sense to me.
Right. I agree with that.
So Dow Jones, how's that?
Dow Jones, similar to the Qs. I mean, and this has been killing me because it's going against me. The last three looks that I had on it, it's morphed. So we're looking for a little bit more of a push. Last week we bumped up to about a 355 push, and this week we're going to push up to 371 in the count.
Yeah.
There's just the volume was coming into the tape a little bit there, and then my strategy again is saying that we're going to have a shallow drawdown, whereas Motive Wave says that we're going to have a 4 down there around 310.
Yeah.
We should stay in that range, I think, through next week between that 354 and that 368. So there's some upside there in the Dow now, which we didn't have last week.
All right. Let's see next. IWM, and this is already gotten quite beat up, and it hasn't kept up on the upside either. So
it keeps flipping back and forth. This is it's my opinion, and it's Mr. Market constantly humbles you. My opinion is still we didn't take out the 201, but the count tells me that we're going to push to that 237. So, I mean, my bias is only an opinion, the way I look at it. And as I look at the tape and the count, I trade off of the tape. So, ultimately we break above that 161 fib, that 225.62. We get a close above that. That really would be my signal to maybe try a shot long for that 237. But I have other positions I would be more interested in chasing than IWM, just because of how euphoric it's been in both directions. I mean, it seems to come on suddenly, like all of a sudden it's of interest by a large number of buyers, and then all of a sudden the same number of buyers are selling. I mean, and I'm talking a significant number to move the Qs the way they've been moved, because it's always been a tape that consistently grinds. Either it grinds up or grinds down slowly. It really has not had those euphoric moves that have been very aggressive. It's always been consistent and steady.
All right, see here. TLT.
Now, TLT, we're heading for that 4. It just is manifesting where we were last week.
Yeah. Do you think it can come down lower, down to here?
Maybe. I mean, right now, TLT is an I don't know, because what happened, the gold contracts really, it echoed in a different way than I would suspect. I mean, you could see with that large, I mean, my opinion is somebody got liquidated, but I don't, I can't see that. That came out of the New York Fed, or at least the data that I was hearing about, and they blocked that from our view. So I can't tell whether it was one large party or multiple parties that collectively got together and sold. But, gold has always had a reflection in treasuries, because quite often they have, you have the gold contracts are secured by treasury holdings. So there's always some form of a relation there. So right now, I like the idea of chasing this to my 5, which is up there about 200. But, just like you, hey, can it go down to here? That's what I don't know. I mean, I'm not short and I'm not long here. Let's put it that way.
Yeah. And that's a good point. So sometimes there's just no trade to make.
Yeah. Best thing to do is sit on your hands. Okay. Now gold, actually, we got a 3 drive here that manifested off that 1721. So, right now, if it completes, it could push all the way up to the 8-day, the pink line. However, the count is telling me it's going to push to about that 1779, and then we're going to fade back down and should complete around that 1664 that I had.
Yeah.
But if you are in some gold positions and you're a little concerned about that 1664 and you don't want to take that $110 in heat, obviously that 1779 might be a place to trim and, wait and see where we are, and then add it back based on whether or not that holds or doesn't hold, a week or 2 or 3 weeks down the road.
So, of course, I don't trade gold really, but I do invest in the gold miners because of the lower correlation to the broader stock market.
Right.
Somewhere between bonds and stocks. And
right.
I've lightened up on my gold miner position because, well, a little bit to do with gold, but not much. But really because I just think that if the market sells off for a hot minute, it'll go with it. Just like it did, early last year. So you'll get that hot minute where maybe we can buy the gold miner ETF in the middle 20s or lower 20s. I don't think it'll match the low that it had in March of 2020, but it could, get 60% of the way there from the top. And the top
right.
was 46. So 46 to 16 is 30 is the difference. So 60% of 30 is about 18. So 46 minus 18 is about 28-ish. I mean, that's, it could even be, it's the other fib levels, 0.718. It could even be 25-ish, 24-ish. So, I've lightened up on the gold stocks just like I've lightened up on everything else, because a sell-off is a sell-off is really what it comes down to.
Right.
All right. Who would be interested in Ethereum?
Let me tell you what, I've gotten to love to trade this thing. I'm not only in common, I'm in futures, and I'm even holding some in compound for the dividends there. I just have gotten to love this thing, but it looks to me like we're going to push a little higher. I had a count down around 2,900 for a pullback. We didn't get there. I covered a little bit, around 32.15, and then I bought all of it back really at 3,040, I think it was. We're looking for 34.30. Then we'll break back down and get about 2,700 for another good entry, hopefully. One thing about crypto is it tends to push a little beyond the counts, usually 8 to 15%. And if it's moving in an uptrend, it tends to be shallow to the downside. So you really sort of have to stock the drawdown, the back tests, to get a decent position and scale in. And a little different beast. Where did I buy Ethereum? Then, like a little kid, I sold it because I was like, oh, quick profit. I think in here, because it might have only been in May then. So anyway, I traded Ethereum once and Bitcoin. Then I sold them, and then I was a scaredy cat. I didn't buy them down here. And the reason I didn't buy them back is because I think there's unknowns with regard to what government policy is going to be. And I thought before the infrastructure bill, the unknowns were even greater. So the way that the infrastructure bill is working is it's basically opening up the whole thing to regulation. However, there's 2 more steps to go. So while they're saying, okay, let's take a look at everything, that's basically what the infrastructure bill is going to do. It's going to say, let's take a look at everything. The reality is that there's a process here. So there'll have to be laws that actually get passed, tax regulations that get instituted, Securities and Exchange Commission rules that have to be written. There's public comment periods. So there's a 2 or 3 year process here to how they're going to end up regulating cryptocurrency. And it seems to me that at this point, the stable coins are for sure going to be out there, and they're going to get regulated like money market accounts. Agreed. So that would drive demand for what? For U.S. securities, right? For U.S. government securities. So I don't think the stable coins go away. I think the stable coins stay, at least 3 or 4 or 5 of them. And they will become basically crypto money market accounts. And then your big banks will get into it. So, short-term U.S. Securities, I think, are going to be pretty popular again because they're going to get tied into the crypto market. Now, which other cryptocurrencies are going to survive? I think Bitcoin survives. I think it gets super volatile at some point, and maybe there's a buy price. Now, you can certainly trade stuff if you're adept at doing this. But again, remember, Scott and I are only trading 5 to 10% of our portfolio, right? So, I think he's closer to 5, I'm closer to 10. You're trading around the edges, and you're looking for those bigger moves on a smaller amount of money, and for it to happen fast. But I think one of the huge benefits of the trading, by the way, is it just keeps you in tune with the market. It doesn't mean that you have to be the gambler throwing all your money on the table. Granted, you're going to want to get good at it, so you're making money rather than spending money. With Ethereum, it's tied to the NFTs. And I think that Ethereum, probably surpasses Bitcoin in market cap at some point in the next year or two. Dr. Sean Stein-Smith and I talked about that in the one webinar, and I'm going to interview him again this fall. So, I think it's interesting when you take a look at the crypto space. I will say, with the exception of the stable coins, Ethereum, Bitcoin, maybe 1 or 2 others or 3 others. All right. That is the Bitcoin account adoption. That's the growth of new accounts that have 0.01 BTC in them. Yeah. That doesn't look like a declining market to me. That's the type that is the metrics that is supporting the growth in the crypto market. As long as that continues in that uptrend, and realize that if you look at the count from the drawdown that we had down to about 7.6 million, we're still in wave 3. That first little tick down there, a little bit lower where your marker is, a little lower, a little higher, halfway between that, up a little higher, right there. That's wave 1. So we're in wave 3 right now. Wave 3 is usually the longest wave. So that should extend upwards of 8.5 to 8.9 million from there.
Yeah.
And then we still have wave 5 to put in after that. So I would assume the adoption exceeds 10 million within the next 24 months.
Well, and I'd be interested to see what this chart looks like for Ethereum. So I'm guessing they have that. So I would expect that Ethereum will adopt faster than Bitcoin. And the reason being, so Bitcoin you're never going to buy your pizza with, but you might get a stake in something using Ethereum, which is tied to the NFT contracts.
It's also the new kid on the block too.
Yes, and it's a new kid on the block, but the disruption in real estate is going to be massive. I know not a lot of people are saying this yet, so please remember me in your thoughts and prayers. And boy, this guy should have been on TV, because I'm telling you right now, real estate is going to be massively disrupted by NFTs.
I'll stick my neck out.
Yeah.
Ether 7K by the end of the year.
You think so? Yeah. Well,
yes, sir.
Then get us a dip to buy. In any case, all right. So we've looked at TLT, we've looked at Ethereum, and what's this last one here?
This last one's SLV. Actually, it's a buy now. I like silver better than gold where we are right now.
A lot of people are saying that.
Yeah. The upside's significant. This is something I think you could buy common and trade either side of it, depending on what your portfolio structure is. But I like it just for, a decent swing and, ride the waves going up because it's got a nice base here,
Yeah. And me being the scaredy cat, thinking that we're going to get some sort of volatility in the near future, how far could this extend down on, say, 2 or 3 months of volatility?
It really depends on a supply and demand metric to it. That every EV that's built, every cell phone that's built has a level of silver in it. Even though we don't have as constrained supplies as we have even in copper at times, just because of the demand. We're seeing some supply shortages, especially in Europe in silver. So I don't know that it's going to have, the downside is always the 161.8. So you can go from that 5 all the way to the left of the screen down to the C and measure up to your 1 on a Fibonacci extension tool. I can't actually do it live for you, but your 161.8 would probably be somewhere around $15, I would think, on the downside.
All right. We're at an hour, so let's wrap this up. Folks, remember these things at the end, if you're not trading more regularly, you got, maybe not do these. But if you're trading a part of your portfolio, remember these are basically, you're looking for weekish to a little 2-week moves, sometimes a few days, but he's using an 8-day measure. So, a couple weeks. I mean, these are moves that you don't put on and then come back in a month. You look at these every day. This is instructive to us as longer term traders, just to understand where the market is so that we can look for our longer term buy spots. And if you're going to trade it, just make sure you keep up every day. In the chat room, I see the chat rooms have had a lot more people in them lately. The fundamental trends chat rooms have a lot more people in it lately because that's where we do the swing trading. And I think the general message is you shouldn't be buying a lot of things right now. There are some cheap things that I have in my list that are in the buy zones, especially if you sell puts. I really have to reiterate, I know a lot of people want to call themselves dividend growth investors, but really investing is investing, buy low, sell high. So if you really want to generate cash flow, you will generate more cash flow selling puts on better companies than you will collecting dividends from overvalued or worse companies. And a lot of the dividend stocks are just grotesquely overpriced right now. And I just don't see how they're going to continue to grow their companies and transition their companies, especially the asset heavy companies or the companies that are being disrupted by technology. There's a lot of companies out there. I've told you before, between 100 and 200 companies on the SP 500 have big problems coming. And I think you're playing with fire if you're saying, well, but it's not yet. The problem isn't yet. Well, the market's going to decide, not you. All right, I'll let you go. Everybody have a great weekend. Enjoy summertime. There's only a few weeks left.